Hello, I'm Justin Urquhart Stewart, and I'm here with my colleague Chris Darbyshire. He's our Chief Investment Officer. I'm just going to do a quick roundup of this year, but more importantly, I think look forward to next year. Now, Chris, we were slightly worried about this year because the year before was a stunning year, so this year was going to be a bit difficult. But it sort of turned out all right in the end.
Turned out okay for investors. The world economy was maybe a bit shakier than we had thought going into the year, but on the whole, the world economy has still grown.
But is this one of these issues, the difference between what happens in the economy and actually what happens in markets?
Very true. So the markets are pricing in and factor in a lot of growth in the world economy that we didn't see this year. So investors maybe get a little bit more nervous because they see the market really rallying and they hear lots of bad news about the economy.
We're getting flashing dashboards from our Prime Minister, amongst others. Are we worried about all these lights flashing, or does he just need a new car?
I think he's not the person, maybe the best qualified person to be commenting on the economy. I think the economy is growing but slowly. Next year is looking pretty good, actually, and in fact the recent decline in the oil price has sent GDP forecasts rising quite significantly.
So that's going to be quite a sort of unexpected boost to a lot of economies who actually consume oil.
True, and it boosts demand, consumer demand, which has been missing for the last 5 or 6 years. So we might be getting completely unexpectedly the solution to one of the big problems.
So what's facing us next year then in 2015?
So I think we've got, will the US return to its normal rate of growth, which is around about 3%? Didn't quite manage it this year, although that may have been more due to winter storms than anything else. So next year, I think the odds are pretty good. We've got Europe. Is it going to continue to be quite as lacklustre as it has been? And in fact, the austerity policies in Europe, which are slowing economic growth, seem to be falling away. So we might get a bit of a boost in Europe next year.
OK, so we've had two things which you've highlighted as being rather concerned because there were consensus views on the dollar and also with what's happening with the Eurozone as well. Do you think actually it's time to go against those consensus views?
Yes, I do. I think US economy, strong dollar, that is now so much in the market, and it's actually been the case for 6 months now that the dollar's been rising very significantly. We're actually positioning ourselves on the opposite side of that trade, or progressively working our way into that. We worry that when that's become consensus, that a small disturbance in that mindset could actually result in quite a big market movement.
And that other consensus of the Eurozone and what's happening now?
For the Eurozone, yes, people are very negative on the Eurozone, very worried about triple dip there. But actually, the Eurozone data is okay. The deflation concerns aren't quite as bad if you look at the core inflation figures rather than the headline inflation, which has got more volatile energy and food costs in it.
So ignore the hyperbole on this. Let's come back to Blighty then. What's the outlook here? Because we've got the election coming up and that's going to cause some...
Again, a very negative outlook for political risk seems to be rising a great deal, and sterling has been very weak recently, and that's a very big concern for our investors. So we're quite optimistic that UK GDP forecasts are perhaps a little bit lacklustre for next year, that the economy is doing okay. We think that the political risk, which is probably a little bit overdone, and maybe some UKIP voters and maybe some SNP voters will actually go back to being normal voters at the time of a Westminster election rather than a by-election or a Scottish referendum. So I can see us being a bit more optimistic on sterling in the short term.
And towards the end of this year, you've been saying, go east, young man. You've had more focus on that. Does that carry on for you next year?
Yes, I think it does. I think we've been trying to position the portfolios more into Asian economies with a bit more China exposure. And a lot of interesting things going on in China at the moment. Chinese stock market has been doing very well recently. And it seems like the Chinese government has got that economy somewhat under control, and it's not going to have a horrible meltdown, which is the fear. And that's very important because it's now the second biggest economy in the world. It will stimulate other markets in the region, and we've got Japan as well in the region, which is showing potential to grow at a faster rate.
And all those areas really benefiting from these low cost of commodities and especially oil.
Yes, so the Asian economies are commodity importers, so oil price going down is very good for them.
Now, the latter part of this year, you actually took some profits on Japan because you're waiting for the election now, or what?
Well, you know, it was up 10% in just a few days, and that's an awful lot of good news being priced into the market. So we've begun to bring our exposure down. We're still overweight, just not as much as we were.
And overweight equities overall?
Yes, we'll continue to be overweight equities overall. The reduction in the oil price, I think the boost to demand that gives us is probably enough to keep us overweight equities.
Now, the one that's always the most difficult call of all, it's like catching a falling knife, is what happens with the currencies? What should we be doing there?
So I think we're going to hedge the dollar in the short term, or continue to hedge the dollar position. Not that we think sterling really has a great future, but it's run so far now down against the dollar that we think it could rebound. So we're probably going to stay underweight UK equities,
right,
which has been a big part of our strategy for the last year or so.
And what about the fixed interest world as well?
Fixed interest world, I mean, we didn't do a terribly good job on that this year. So we were underweight government bonds, and we were particularly underweight the long-term government bonds, which did the best this year. And we were surprised by that.
But the risk is still there, isn't it?
I think the risk is very much there. And I think one thing to realise that this year you won't have the US government doing QE, which put hundreds of billions of dollars into the US government bond market. That will be absent this year.
And some of those other asset classes as well, some of the balancing ones.
Yes, so we like private equity.
Right.
It's a way of getting exposure to US companies, but without the very high valuation that you'd get them at if you were buying through the regular stock market.
But nowhere near commodities for the time being.
No, we're going to stay away from commodities, I think, in the near term.
And property?
Property has been a good performer this year. I think we are, because it's been such a good performer, we're probably less interested in it than we were. We're neutral for now, but okay, I think with a view to perhaps going underweight at some point.
So a broadly diversified as before, but with a greater weighting towards equities is going to be the outlook for the moment.
I think continuing that overweight towards equities, certainly in the first part of next year.
Okay. Chris Darbyshire, thank you very much indeed. I hope you find that helpful. In the meantime, may I wish you a wonderful Christmas and Hanukkah and a Happy New Year.